So good morning, good afternoon, or good evening to everyone. So this is our first topic for midterm, the theory part of profit planning and CVP analysis. And to start with, let's have first the basic principles for the CVP analysis and profit planning. One is variable costing model shall be used for profit planning purposes. So later on, we will know what is this variable costing model. So this is what we used for profit planning purposes. Second is cost is equal to variable cost plus fixed cost. So variable cost, those are costs that varies in relation to production or to the number of units sold, and fixed cost, of course, those costs that do not change, within, as long as it is within the relevant range. So we will know this further when we will have our example later on and for the next slides. Then third is the term cost covers cost and expenses. Then operating expenses are made within the relevant range. When we speak of relevant range, that's the range in which the company produces uh, units, no, within its maximum capacity. Now, within its maximum capacity. So, if the company is producing products within our not exceeding its maximum capacity, then the company is producing products within the relevant range. Next is profit is equal to sales less cost. Then profit is equal to sales less fixed cost less variable cost, since cost encompasses fixed cost and variable cost. Then contribution margin is sales less variable cost. So that is your contribution margin. Then profit is equal to contribution margin less fixed cost. So breakdown ta lang, no, ang aring formula nga profit is equal to sales, profit is equal to sales less cost. Then this cost will be broken down into fixed cost and variable cost. But if variable cost will be subtracted from our sales, then we will get the contribution margin. Then we will get the profit when we subtract fixed cost from our contribution margin. Then relevant range and its assumptions. So relevant range is the width of activities where the relationships of cost and revenues are predictable because it is linear. So there are two related perspectives in predicting profit, namely, first is the basic assumptions perspective, and second is the sensitivity analysis perspective. So when we speak of sensitivity analysis, it involves predicting the outcome of a situation after considering the effects of the changes in the variables affecting the outcome of the said situation. So, for example, what would happen to profit if unit sales price increases by 12%? So the change is in sales price is the sensitivity, and its effect on profit involves the sensitivity analysis. So later on, we will understand more of this sensitivity analysis when we will have examples, for this, and it is also stated there in your module. Then next is the profit planning assumptions under the two perspectives are as follows. So we have here profit variables, in which these are the variables that we consider in profit planning, and its basic assumptions, and it's the cost volume profit analysis. CVP means cost volume profit analysis. So we analyze the cost, we analyze the volume, then the effect on profit. So first is the unit sales price. So its basic assumption, it is constant, it does not change. If for example, you increase production or you decrease production, your unit sales price is still the same. So that is why it is assumed to be constant. So if a CVP analysis, it changes. Then next is unit variable cost. Basic assumption is constant, staying with the unit sales price, also the total fixed cost, the sales mix, and the quantity sold, of course, it changes. And when it comes to CVP analysis, it changes. In-process inventory, none. We will later on discover why work-in-process inventory is not considered now in CVP analysis. So also none for the CVP. And production and sales, basic assumptions, we assume that production is equal to sales, no? And we also assume that production and sales are equal when it comes to CVP analysis. So basic assumptions in profit planning, first is linearity. The behavior of sales and cost is linear in relation to changes in quantity. So there is somewhat a direct relationship between cost and sales, no? When quantity, in relation to quantity. So there is a direct relationship now for sales and cost with quantity produced or sold. Then next is unit sales price is constant, variable cost rate is constant, then total fixed cost is constant. Then quantity sold changes, no? And everything here, unit sales price, variable cost rate, total fixed cost is constant. Next is behavior. Sales change directly in relation to the level of units sold. So the total fixed cost is constant regardless of change in the level of production and sales. So when we speak of relevant range, if the company is producing within its relevant range, whether as long as it is within, whether they decrease their production still within the relevant range or increase their production as long as it did not exceed the relevant range, your total fixed cost is still the same, no? Kaya whether or not you produce, you still incur fixed cost. So that is why it does not change regardless you change the level of production and sales. But unit fixed cost changes inversely in relation to the level of production. Why? You have your total fixed cost. It's constant. It does not change. But unit fixed cost changes, inversely in relation to level of production. For example, if you increase your production, diba, your total fixed cost does not change, but your unit fixed cost will be decreased, no? If you increase your production. Why? Your total fixed cost divided by the number of units sold. So kung damo ka may gin-produce and ginbaligya, damo may matunga sa imo fixed cost. That is why nagagamay ang imo unit fixed cost when you produce and sold more. But if jutay lang ang imo gin-produce kag imo ginbaligya, therefore dutay lang ang matunga sa imo nga total fixed cost. So in effect, your unit fixed cost will increase. So that is why there is an inverse relationship between unit fixed cost and the level of production. So we have their example, unit fixed cost decreased as the level of production increases and vice versa. No? So always take note the total fixed cost is constant, but unit fixed cost changes inversely in relation to the level of production. Kaya mo nagatunga kay fixed cost if you produce more, and jutay ang nagatunga kay fixed cost if you produce less. Then variable costs change in direct proportion with the level of units produced and sold. So unit variable cost is constant. Suli naman saya kay fixed cost. Variable cost in terms of total, now there is a direct proportion or there is a direct relationship between the level of units produced and sold and variable cost. Why? The more you produce, the more variable cost you incur. The less you produce, the less variable cost you incur. We have examples of variable cost. That is your direct materials and direct labor. If you produce more, you require more direct materials. You require more direct labor. If you produce less, you require less direct labor. You require less direct materials. So that is why your variable cost is directly proportional to the number of to the level of units produced and sold. But unit variable cost is constant. It does not change whether damo ang gin-produce mo or less ang gin-produce mo. For example, your direct materials is 10 pesos per unit. So it will not change, no? Since amo na ginaya ang price ng imong direct materials and your direct labor butang ta is 5 pesos per unit, no? Produced. So it will not change. It will only change when it comes to total. So pila to gani 10 pesos for direct materials, then 5 pesos for direct labor. So you have a total of variable cost of 15. Butang ta, you have two types of cost under variable cost now in producing a product. So you have 15 pesos as your variable cost. It's constant. 15 pesos is the unit variable cost. That is constant. And it will not change. It will change in terms of total. So when you produce 10,000 units times 15, that's 150,000. That's your total variable cost. But if you produce 5,000, you will only incur 75,000. So that your variable cost changes in direct proportion to the level of units produced and sold. But your unit variable cost, it does not change. It's constant. Then variable cost and fixed cost behaves as follows in relation to changes in the level of production and sales. So you have here the summary. No? If your level of production increases, so your variable cost per total also increases since we have a it is directly proportional to the level of productions and sales. So when our level of production increases, our variable cost per total increases, our variable cost per unit is constant. It is still the same, no? Ang price ni direct materials, ni direct labor, it will not change regardless you increase or decrease your production, no? That's your variable cost per unit. Well, under fixed cost, when you increase your level of productions and sales per total, it does not change as long as you are producing and selling within the relevant range. But when it comes to fixed cost per unit, when you increase your production and sales, your fixed cost per unit decreases since damo nga units ang naga-share kay fixed cost, no, kay total fixed cost. So that is why nagagamay ang aton nga fixed cost per unit. So there is an inverse fixed cost per unit is inversely proportional as to the level of production and sales. And also when you decrease your level of production and sales, your variable cost per total also is also decreased. Your variable cost per unit, it is constant, and your fixed cost per total, it's constant, and your fixed cost per unit, when you decrease your level of productions and sales, it will increase since due tayo lang na nag-share kay fixed cost. Okay, so that's it. Number 5 is variable cost and fixed cost, either in total or per unit, are not affected by the change in unit sales price. So when we change our unit sales price, for example, we charge initially for a product at 10 pesos, but if we change it to 15 pesos, it will not affect our variable cost and fixed cost. So that is what it says here. No? So technology, it will not be affected. Consumer behavior, loss, competition, and other business variables. Next is products. So there is only one product, or if there are 2 or more products sold, the sales mix is assumed to be constant. We will understand this more if we will tackle some examples there in your module. Then this is the variable costing model. So under the variable costing model, the variable costs are deducted first from the sales to get the contribution margin. The presentation formats are as follows. So variable costing model, in here we are going to see the cost that is being separated, no? The variable cost can be seen, and also fixed cost can be seen. And what is this contribution margin? So you have here sales, no? Less variable cost and expenses, variable cost and variable expenses. So your sales less your variable cost, that would equal to your contribution margin. Then when you subtract your fixed costs and expenses from your contribution margin, that is where you get your profit. So this is the variable costing model. No? Sales less VC is equal to CM less FC is equal to profit. So that's the variable cost, the variable costing model. So variable production costs include direct material, direct labor, and variable overhead. Those costs that changes, no, as in relation to your level of production and sales. So examples of your variable expenses are delivery expenses, salesman's commission, and packing supplies. So if you sell more, of course, you deliver more, so you incur more delivery expenses, and you also pay more to your salesmen as their commission, and also you also pay more for your packing supplies now for those units that you have produced. So if you produce less, this will also be decreased since you will be delivering less goods, you will be paying less commissions to your salesmen, and you will be buying less packing supplies. Now, what direct fixed costs and expenses are those that are directly related to this segment, for example, division, department, or product line. These costs are directly identified with the segment, and once the segment is discontinued, these costs are avoided. When we speak of, for example, the best example for fixed cost is your rent expense. Now, if you are renting your facility, so whether or not you produce, you will still pay your rent. So it is fixed cost. No? So that's the example of it. So we have here the relevant formulas. So let's tackle this one by one. Then we'll go through one example. Then I will make another video next week for more examples now. So I'll just present you one example for this video so that you still have time to digest it. Then if you can go through your module and review the remaining examples, then it's good. Then I'll just do or give you a supplemental video next week. So we have here first formula for our contribution margin. So contribution margin from our variable costing model, we have sales less variable cost. That would be your contribution margin. Your sales less all your costs that change that varies in relation to your level of production and sales. Or contribution margin is equal to sales times contribution margin ratio. So there might be problems that will be presented to you to answer that only sales now in peso and percentage for contribution margin is given. So you will be asked how much is the contribution margin. So you simply multiply your sales by its contribution margin ratio. Later on, for example, we will see where are we going to get this CMR, know how to get it, and to do some work backman no when it comes to these formulas. No, we don't have to memorize. No, we only need to understand why nag-amoni ang formula. Next is CM is equal to fixed cost plus profit. So in this formula, it's somewhat like naga-work back kita. For example, profit ang nahatag, then fixed cost. Then you will be asked how much is the contribution margin. So from down to top, no, isang formula to isang variable costing model. So makuha mo siya contribution margin. So as what they have said, no, so there are many ways to kill the cat. So there are many ways to get the contribution margin. Or the contribution margin, it would be equal to quantity sold times the unit contribution margin. Unit contribution margin is the contribution margin per unit, no, the price, no, of the individual product, no, the contribution margin of the individual product. So amo na siya yung unit contribution margin. So times the quantity sold. Okay, then contribution margin ratio. When we speak of a ratio, yeah, it's presented in percentage, no? So CMR is equal to 100% less the variable cost ratio, no? So you will get the CM ratio, or CMR is equal to CM divided by sales, no? Karon makita ta na. Then CMR is equal to unit contribution margin divided by the unit sales price. So that's your CM ratio. Why? Your unit contribution margin, di ba? It's that, of course, ano na siya, pares na siya ni contribution margin. So, unit contribution margin. Pares naman yan ni sales price is the unit sales price. So, somehow related here. No? Direya in total, direya per unit. Sum na siya yung formula. Then CMR is equal to change in EBIT. EBIT is earnings before interest and taxes divided by change in sales. Now if FC remains the same. So we will have an example for this later. Then the unit contribution margin. Unit contribution margin is your unit sales price less your unit variable cost. And your unit contribution margin, fixed cost divided by break-even point in units. And from there, you will get your unit contribution margin. Unit contribution margin could also be derived by dividing your contribution margin divided by the quantity sold. Then for profit, that's profit is equal to contribution margin less fixed cost, or sales times the margin of safety ratio. Later on, we will know what is this margin of safety. Sales times margin of safety ratio times your CM ratio, or sales times your net profit ratio. Or change in profit is equal to change in CM less increase in fixed cost. Change in profit can also be derived by adding change in your contribution margin plus your decrease in fixed cost. Okay, break-even point. Okay, break-even point. You have there the formulas. No, I'll just not mention it. So when we look at here, summation of your product unit contribution margin times sales mix in units. And this is very difficult to teach kid kung wala example. So we're done with the break-even point. Now break-even point formulas. So at BEP, profit is 0. So at BEP, ano ka lang, balik lang ang imong capital. No? You have no profit, you have no loss. No? Ara ka sa break-even point. No? You're producing at break-even. Naman ba nila? Then your sales is equal to your total cost. Still you're at break-even. Your contribution margin is equal to your fixed cost. That's break-even. No, you don't incur losses, you don't incur profit. So you're at break-even. Fixed cost, just look into your modules for the formulas. So we will understand this when we have examples. So I'm gonna share one example now for this video. So you have here your problem 1 there. Melanie Company. So just go over with your module right now. So you can also refer while listening to this video. So you have here problem 1. That's Melanie Company produces a merchandise that has the following data. So this is the only data that it provided. Then these are the requirements. So you have unit sales price. That's 80 pesos per unit. That's the sales price of each unit. Unit variable cost, it's 48 pesos per unit. That's the variable cost. Its total fixed cost is 640,000 per annum. That's the amount of fixed cost that they incur for the year. And the units sold during the period is 25,000 units. What are the requirements? First is the unit contribution margin ratio, and the variable cost ratio. So in here, we are going to use the variable costing model. Then break-even point in units and in pesos, margin of safety in units and in pesos, and the margin of safety ratio, the profit ratio, the amount of profit using the margin of safety, and we have here a sensitivity. analysis now. If sales increase by 300,000, how much would you expect? How much would you expect profit to increase? So, ang balya is, what if you increase your sales by 300,000? Ano ang effect niya sa profit? So, let's take this one by one. First, ginapangayo niya is the unit contribution margin and the contribution margin ratio. But first, let's have this set up, no? So, hambalya, 25,000 units daw. So, you have here your variable costing model, no, para makita tanan, your sales, your variable cost, your contribution margin, your fixed cost, and your profit, no, profit before tax. But then, didn't mention if there is tax. So, let's consider this as your profit. So, you have your units, number of units, you have your unit price, that's your unit, the price per unit, and the total amount, and the rate. No, para isa lang. No, we're hitting many birds in one stone. So, that's plot. For the sales, it says there that they have sold 25,000 units now for the period. So you have here sales of 25,000 units. And of course, variable cost, you also incur cost for these 25,000 units. So it's still the same. Now, this is constant. Then, since we assume that production is equal to sales, no, but if the problem say it only produces 100,000 but sold only 75,000, so that's a different approach naman, no. But in here, let's just assume first that sales is equal to your production. So we're done with the units. Then unit price, it says there that unit selling price is 80 and your variable cost is 48 pesos per unit. So if you subtract 48 from 80, you will get your contribution margin per unit of 32 pesos. So 80 less 48 ng variable cost per unit. So you will get 32 pesos. That's your contribution margin per unit. So as to amount, it's let's just multiply 25,000 units times your unit price. So that's 2 million. Then let's drag there. Your total variable cost would be 25,000 units produced and sold times your variable cost per unit of 48. So you have a total of 1.2 million, no, of variable cost. So to get your contribution margin, just follow here, class. To get your contribution margin, you just simply subtract sales, no, less your variable cost. So you will get 800,000 contribution margin, less your fixed cost of 640,000. So you will get your profit at 160,000. So how to get the rate? So rate, sales is 100%. We assume that sales is equal to 100%. Your variable cost would be your variable cost divided by your sales. So that's 60%. Therefore, your contribution margin is 40%. So si 40% ni or si 800,000 will be the one to absorb your fixed cost. Then if ma-absorb yan ang fixed cost, ang bilin would be your profit. Okay? So, amo na siya. So, requirement A, nakuha ta ng unit contribution margin, that's 32. Your contribution margin of 40%. Then your variable cost ratio of 60%. Okay? So that's how we get, no, that's how we approach, no, requirement number 1. So requirement number 2 is your break-even point in units and in pesos. So if you go back to your formula, your break-even point in peso and in percentage is equal your fixed cost. That's fixed cost divided by your CM, no? If we go back. That's your break even. Okay. break-even point in units. Nadula ko. Class. Okay. So I think you're seeing now my screen again. Your break-even point in peso, let's have first your BEP in pesos. That's your fixed cost divided by your CM ratio. Okay, that's your break-even point in peso. Then break-even point in units, of course, that would be equal to your fixed cost divided by your CM per unit. Okay, so we'll see. Break-even point in pesos, that's your fixed cost of 640,000 divided by your 40% no CM ratio. So you are at break-even if your sales is around 1.6 million. Okay, you are at break-even. Break-even point in units, medyo na-lost ko class. Break-even point in units, that's your fixed cost of 440,000 divided by your 32. So you have, no, this is not peso sign. It's general number. 20,000 units. Okay. 20,000 units. So you have to sell 20,000 units to be at break even. Okay. So to check, itang tadi class, kato tadi. This is to check lang. No, kung to show you the checking sang paano bala mag-check sakto gito ang aton answer. Okay, hambalya ko no. Still the same. Okay. Hambalya, you have to sell 20,000 units to be in break even, at break even. So at break even, your sales, no, your profit is zero. No, you have no loss, you have no gain, no loss, no gain. So you are at break even. Hambalya, you have to sell 20,000 units, and also 20,000 units. Now, as you could see, Hambalya, when we get the break even point in peso, your sales must be 1.6 million. So, siya, nagwa siya. So, our answer is correct. No? Our sales price per unit will not change. Our variable cost per unit will not change, even though our number of units sold, produced and sold changes. No? So, nothing changes. So, this is to check, no? Still, your variable cost ratio does not change. Kaya wala man nag-change ang aton variable cost per unit. And also our contribution margin. So 20,000 at 20,000 units, you have no gain, you have no loss. So you're at break even. No? So we're done with requirement number 2. So requirement number 3, margin of safety in units and in pesos and the margin of safety ratio. So what is this margin of safety? So you have here the formula. You have your actual sales since you have sold 25,000 units, and we already get the break-even point in peso and in units. Simply, the margin of safety is the difference of your actual sales or actual sales and your break-even. So, ang margin of safety means amo ni siya ang amount or ang number of units mo nga daw pwede mo pa madula, no? Until you break even. No? So, kanta lang. Muna sa class, daw amo ni siya ang imo bala nga ano ganing tawag sina. There is a term for that. So, no mo na pundo, no? I forgot the term yara na kung magbaligya ka bala, you have naman backlog or something. Sa mo na may ano ka bala, may allowance. You have an allowance until you break even. So that is the margin of safety. So margin of safety is simply your actual sales, no, less your break-even sales. That's in pesos and in units. So your actual sales is 2 million, no? Kay nagbaligya siya 25,000, but then your break-even is only 20,000 units. So of course you will have a higher sales, no? Sa actual. So 2 million imo actual, 25,000 at 25,000 units. So your actual sales will represent the 100%. Yes, less your break-even sales. Your break-even sales is amo to kaginang sa requirement number 3 again kwata, no, which is 1.6 million, and that's for 20,000 units. Therefore, your margin of safety in pesos is 400,000. So you have an allowance of 400,000 until you reach your break-even. No, so may 400,000 kang allowance, no, do ka naman do makagigiho ka pa sinha, no, 400,000, no, and you have 5,000 units, no, na pwede malose until you break even. So to get the rate, your actual sales will represent 100%, your break-even sales is 80%. How to get this? You simply pili ka lang kung sa amount ka sa units, so but I will choose the amount divided by that's 1.6, no, break-even sales divided by 2 million actual sales. So why kay may letter P siya. Okay, so muna 80% is your break-even sales, and to get your margin of safety, that's simply the 100% your less your 80% your break-even sales, so 20%. So you have 20% the margin of safety. Okay, so muna siya class, no? Your profit ratio. How to get your profit ratio? Your profit ratio is sambalya ko, no, is your margin of safety times your CMR. Okay, margin of safety is times your CMR. So your contribution margin per contribution margin ratio is 40%. You have 20% margin of safety, so you will have 8%. Anyway, class P, di mo ni siya makuha, no? You have there, di ba sa baba mayari ka day, no? You have profit before tax. You simply divide your profit by your sales. Then you will get your 8%. Sabi na sa class, no? How to explain this formula? Okay, di ba 40% si contribution margin? So 20% yan na di is your profit. So 20% is your profit. How to explain this to you? I have something in my mind, but hindi ko siya ma-turn into words. 20% ni siya. So, butang tabi, it's 20. Okay. So, 20% ko no si margin of safety. No. No, I thought this will be your 100%. No. Okay, never mind. Sama na sa class, no? Shortcut. If you have your profit, if you already have this, makuha mo na tanan. No? Your profit ratio, your variable cost ratio, no? No, except for the margin of safety, in which you will use another formula. Now, just simply subtract your break-even sales from your actual sales, then get the percentage, then you will have the margin of safety in amount, in units, and in rate. But this, sa margin of safety mo, okay. Anyways, basta mo na. So that's your formula. I want you to, hindi mo na bala pag isauluhon bala ang amuning formula ha. But then, you have this easier way, so you choose the easier way. No, you don't have to memorize. Okay? So, simple ang profit. Ang profit margin is your percentage, ang percentage ni profit from your sales. Tamo lang man na ang iyang bottom line. So, next is if the sales increase by 300,000, how much would you expect your profit to increase? then, if this is within, we assume that this is within the relevant range. Therefore, you just simply multiply your increase in sales by the contribution margin ratio. Kaya nga, wala naman na si fixed cost mo. Si fixed cost siya is na-absorb na to siya sang una mo to nga sales bala, butang ta it's 2 million. But then naghambal siya if you increase your sales by 300,000, so this will make to 2,300,000. So you just simply multiply your increase in sales by 40% nga contribution margin. Kasi may profit ka na di mo at this rate. So wala na, hindi na pag wala na sa may fixed cost nga nabuhin kay na-absorb na ni si fixed cost by this level of sales. But if you increase, as I have said, whether you increase or decrease your production in sales, as long as you are within the relevant range, your fixed cost will not change anymore, no? So, ma-increase by 120 ang imo nga profit. Now, if you increase your sales by 300,000, you just directly multiply your contribution margin ratio to the increase of sales. If you really want to check, okay, ari lang ko. Na 120 gidang increase. So, 2 million. Nag-increase ako no by 300,000. Okay. So, kaano pa ang per unit? Hindi na, di ba, ng 100%. CM is 60%. 40 imo CM. So, to get the peso nga variable cost, just simply 2.3 million times your VC ratio. So, this is your sales. This is your variable cost. This is your CM. This is your fixed cost. This is your profit. Okay, so na. So, nakuha mo na, no? Ang 60% ni 2.3 is 1.3. So, you have your contribution margin of 920,000 and you have your fixed cost is 640. Ang balya, there is a 120 increase in your profit. So, from pila? 160. From 160. Then, nag-280. So, you have an increase of 120. So, muna sa class. Ang iyang checking. But then, naman yung balyan. Increase in sales times the contribution margin. Diretso ko na lang sa contribution margin kay hindi na mag-share si fixed cost sa increase mo nga ina. No, kay na ano na to sa nabuhi na to sa initial mo nga sales. But then, gin-increase mo yung mga sales no, by 300,000. Therefore, wala na sa eksena si fixed cost. No, kay na ano na to sa, ubos na to sa. And your initial sales, you have your profit ng 160. So, basically, if you increase your sales more, your profit may increase na lang din. No? Kasi si fixed cost, ano na siya, constant na siya. So, that's it. Always note class, no, sa problem, be mindful. There is a difference when we say increase by and increase to. So, increase by 300,000 meaning 300,000 iya ginsaka. But when we say increase to mambal siya increase to, for example, we have here 2 million. Mambal siya, yeah, the sales was increased to 3 million. So, hindi ka mag-add 3 million sa 2 million kay increase to. So, from 2 million to 3 million. So, there is an increase of 1 million. So, there, if you revise the statement, it's also the same with increased by 1 million and increased to 3 million. So, there is same effect. So, take note of that. No? So, that's it. We're done with the first problem. So I'll make another video for the remaining problems, no, para makilala pagid ang iban nga mga formulas. But in here, all the foundation formulas is presented, no, using the variable costing model, the break-even point formulas, the margin of safety, and the how to get the net profit ratio, no, shortcut, no, the increase in profit, no, if there is changes, no, in these variables, no, there are changes in sales, variable cost, CM, fixed cost, and profit. So that's it. I'm gonna end my video here and continue to read and study your module, and have a nice day.